So hello everyone, and this is Shubhamgiri. You're watching my degree. This video is gonna be about one of the most asked questions to me, which is about the loans. Now, loans are generally of two sort of categories: collateral based, non-collateral based. But I'm gonna differentiate between the private bank loans, collateral and non-collateral based, the public banks loan, collateral and non-collateral based. What are they interested? How do this term called margin works, and what importance does this margin hold in your application process? So stay tuned with me until the end of the video so that there would be something that would be beneficial to you. And if you're watching this video before even you have started the process, it's really gonna be very important for you. So let's start the video.
Everybody get your fucking hands up.
So firstly, let me clear you that there are essentially four kinds of loan. The first one is the centralized bank non-collateral based loan, centralized bank collateral based loan, the private banks collateral based loan, and the private banks non-collateral based loans. Now these are the four kinds of loan that essentially any of the students offer. So what is the difference between these? So the minority of the people would take the centralized bank non-collateral based loan because it's up to 7 lakhs. So if you're availing a loan till 7 lakhs, you can go to a centralized bank, SBI, Canada, anything that goes for you, and they could give you a loan purely on non-collateral basis till 7 lakhs. So that is the bracket of 7 lakhs. Now if you want more than that, it's 100% required that you need to show them some collateral, and that is very essential. Now talking about the private banks, they have collateral and non-collateral based again. So the distinction between the both of them is that the collateral based loan will have sort of less interest compared to the non-collateral ones. Now the utmost difference, like I would say the main difference why people opt for the private banks, is that the private banks would give you 100% of the loan that you ask for. If you have the proper paperwork for that estimation, you would get 100% of your loan sanctioned without any problem. But for the state government banks, such as centralized banks or SBI or anything, they need collateral, as well as they would be having 10 to 15% margin. Now what is margin? We will come on this in a little while, but before that, let us understand that why people go for the non-collateral based loan. Now if someone is from a middle class and it's essentially linked to the margin, but let's just make a difference very clear that if I'm going for the collateral based central government approved, some banks, SBI or Canara Bank, maybe BOB or Bank of Maharashtra, anything of that sort. So they have less interest, that is a good thing. They have good moratorium period. So it's a period in which you don't need to pay any interest to your loan. So that is again a good thing. But for the private banks, it doesn't go like that. So they have high interest rates, but they will give you 100% of the loan that you ask for. So on comparing and contrasting both of these things, a student who needs to avail the loan at less interest, they need to have at least 10 to 15% of the whole estimation that they are going to give to the banks ready with them. So that essentially means, let me get this clear with an example. Now, if you have 10 lakh rupees as their tuition fees, and you split that 10 lakhs into 2 semesters. Semester 1 has 5 lakhs, semester 2 has 5 lakhs. Now, why work out with 10 lakhs and 1 lakhs? That is not a real number, but that is easy to work with and easy to understand. So, assuming that your bank gives you 15% margin, which is the worst case, and maybe followed by every other bank, they give you 10 to 15% as margin. So, understand this margin, assuming that your bank has given you loan, you have your loan sanctioned at 15% margin. Now what does that mean actually? So that means that the 5 lakhs and the 5 lakhs, so totally combined 10 lakhs, has 8.5 lakhs as your loan amount. That means that 50% of your total loan would be covered by you. So if your parents and if somebody of your relatives is supporting you to give some money beforehand, you could go for the less interest loan, and it's really hassle free. No, it's not hassle free. On the other hand, the private banks has the hassle free sort of system, but a centralized bank or a state government, so they have the fixed interest rate, and it's not going to change in 5 or 10 years maybe if you take that much time to repay your debt. But for the private banks, it goes other way around. So their interest range is sort of flexible, and by flexible I mean that they could change the interest rate in maybe 1 or 2 or maybe 3 years or maybe 6 months. It's possible, but it's rarely the case on the education loan, because education loan is strictly monitored by the RBI, and even the TCS on the education loan would only be 0.05% if you pay in dollars in Canada. So that is a very big thing. Most of the people would be scared about the TCS, that would be 5%, but on the loan amount it's 0.05%, on the margin it's 5%. So it will still be pretty cheap than the INR. Now coming back to the margin part. So what is margin? Margin is essentially the amount that you would be paying. You tell the bank that you would be paying that 50% of the money by yourself. And by yourself I mean that every time you ask for the amount or every time you ask for the fees, they would deduct this 15%. So if you will for a loan of 10 lakhs, they would be giving you 8.5 lakhs, and then you can ask for 4.25 lakhs per semester as your fees. So that margin is furthermore divided into semesters. So every semester you need 75,000 rupees ready beforehand. So then bank would give you 4.25, and then it would be combined and then paid to your institution. So this is how margin works. And coming back to the non-collateral based private banks. Now these banks works wonder for the international students from a middle class. So they give you 100% loan. So let's just say you avail a loan of 50 lakhs. They would be giving you 50 lakhs exactly. No margin, no such thing. But then their interest rate would be 11.25, 11.75, 13 or 14 depending on the bank. Regular charges for 11.25 or 11.75 something. Then Axis is different. Axis has probably the most highest rate for education loan as far as I know. Then there's ICICI and all the private banks. But for the nationalized, the centralized banks, these banks charge roughly around, so if you're a female candidate applying for a loan, so it would be roughly around 8.8% to 8.5% or maybe 8.7% at maximum. For the male guys, so you would be charged around 8.5 to 9.5%. So SBI charges 9.3 or 9.25 for the male guys, and for the females it's 8.57 or 55, something like that. So that's how the pretty much the loan things work. And if you have any doubt regarding it, make sure that you message me on Instagram or email me. So I'll be quick to reply as soon as I can. I don't get that many replies and emails and such things. So, or you can comment down below. But if you watched this video till end, do make sure you like, subscribe and comment on my channel. So that would mean a lot to me. So thank you guys. See you next time.